Continuing with topic 2, paper 9, looking at generic derivative products, we move on to 3.3, that is looking at credit default swaps. Now, credit default swap, we're told, most popular type of credit derivative. Now, they generated notoriety in 2008 because they were right at the heart of the meltdown in 2008, the financial meltdown. And that's why the notional amount of the credit default swap market increased from 6.4 trillion US dollars in 2004 right up to 57.9 trillion dollars in 2007, and then fell by the end of 2008 after all that mess with Lehman Brothers, etc., 41.9 trillion US. So it's a significant market. Now, what lies behind it? The buyer of a credit default swap, a CDS, receives credit protection. Now, what does that mean? Well, you have to make a series of payments. It's like insurance premiums to the seller of the swap, often an investment bank, in return for the right to receive a payment if a credit instrument defaults. So if you base it, and you don't have to hold the bond, but if you base it on, say, a corporate bond, a government bond, and that bond defaults, a form of insurance, the seller of the credit default swap will pay you in effect, the amount you lose because the bond defaults. But for that, you have to pay a premium. Now, the buyer of the credit default swap does not have to own the underlying credit instrument, the bond, just as I've said. And the market was originally over the counter. Certainly in 2008, it was still over the counter, and you had massive counterparty risk. That's why we had all these defaults, and it was not regulated. But it says efforts are now being made to regulate it, and that is increasingly so. For the exam, you just have to be aware of the basic concept of a credit default swap. The exam will not go into it in any numerical detail. That allows us to move on to the next of the generic derivative products, and that's options. And this is a big one. There'll be a number of questions on options. And as we introduced in topic 1, we have call options, we have put options, we have American style options, we have European style options, and the introductory bullet points are there on page 2.14. Remember, the seller takes the risk, the buyer does not, and the buyer pays a premium for a call, giving the buyer a right to buy an underlying asset, or buy a put, giving the buyer of the put the right to sell an underlying asset, in both cases at an exercise price, a strike price, or a specified price. We also have the concept of a swaption, and a swaption is an option to enter into a swap agreement. Now, what we did not cover in the introduction in topic 1 is the specifications of a Hang Seng Index option contract. And there they are at the bottom of page 2.14. The underlying index, not surprisingly, the Hang Seng Index. Contract multiplier, as with futures, 50 Hong Kong dollars per index point. Contract value, same concept as futures, the option premium multiplied by the contract multiplier. Exercise style, Hang Seng Index options, they're not American style, they're European. So be aware of that, because that could pop up in a question. And how do we settle an option? Do we have physical delivery? No, it's always cash settlement for an index option. Right, let's look at the features of an option. And we're going to consider exercise style, moneyness, cash or physical delivery, and the valuation of options, starting with the exercise style. Well, in the introduction in topic 1, we saw American style options can be exercised up to and on the expiry date. European style options can only be exercised on the expiry date. Now, an added piece of information which is very important and can be examined, I should say. The value of an American style option should not be less than the value of the equivalent European style option. So if anything, an American style option on the same underlying asset will be more than the value of the equivalent European style option. So just remember, American style option more valuable than European style option on the same underlying, simply because of the flexibility you have as to when you exercise. On the stock exchange, Hang Seng Index options are European style and stock options are American style. Very, very important points. Please remember them. They can come up in the exam. Now, the concept of moneyness, are you in the money, at the money, or out the money? And this is to do with the relationship between the strike price, that is the exercise price, and the market price. Now, if you think about a call option gives you the right to buy the underlying asset at the strike price. So a call option, let's say with a strike price of 100, that means you can buy at 100. Now, if the market price is above 100, that's attractive because you can buy at 100 and then sell at a price in the market above 100. So a call option is in the money when the market price is greater than the strike price. And it follows that if the market price is less than the strike, you're never going to exercise. What's the point of paying a higher price than you'd pay in the market? So market less than strike, you're out of the money. In all cases, when the strike is equal to the market price, you are at the money. Now, it's the opposite way around for a put option. Remember, a put option gives you the right to sell at a particular price. So if the market price is less than the strike price, that's attractive. You can sell at the higher strike price, having bought at the cheaper market price. So when the market price is less than the strike, you are in the money with a put option. And flip it around the other way. If the market price is greater than the strike price, why on earth would you sell at the lower strike price? So you're out of the money in that instance. And as before, strike equals market, you're at the money. Now, is an option cash or physical delivery? Well, on a cash basis, you just settle by cash. Whatever the difference is between the strike and the exercise, you settle for cash. And as I said earlier, the Hang Seng Index products are cash settled. So the Hang Seng Index options are cash settled. You don't deliver the index. With physical delivery, the underlying asset is delivered, the underlying stock. So that follows on that the Hong Kong stock options are settled on a physical delivery basis. So if you buy a call option on an actual Hang Seng Index stock, then if you exercise, you will take delivery of that stock. Option premiums. So we're looking at the value of an option, valuing options. An option value is a combination of the intrinsic value plus the time value. Now, time value will be 0 at the expiry date because there is no time left. The intrinsic value will be positive if the option is in the money. It will be 0 if the option is at the money or out of the money. It's a fairly straightforward concept. Let's look at an example. Value of a call option. Call option on the shares of Examinator.online has a strike price of $25. That means you can buy the stock at $25. If the call option is priced at $7.50 per option, what is the intrinsic and time values of the option if the spot price of Examinator.online is $28 or $22? Now, remember what a call option is. It's giving me the right to buy at $25. And if in the market the price is $28, that's attractive. So the intrinsic value, $3. If I have the right to buy at 25 and the market price is 22, well, you're out of the money. There's no way I'm going to exercise. And so there, the intrinsic value is 0. Okay, looking at the answers, at $28 per share, the option value of $7.50 is made up of the intrinsic value, $3 that I just highlighted, plus the time value, the difference, $4.50. So time value is $4.50. $22 a share, I said that the intrinsic value is 0, so the full $7.50 must be the time value. Now let's look at the value of a put option. Put option, the shares of Examinator.online, has a strike price of $88. That means I have the right to sell the shares at $88. If the put option is priced at $28.50, that's the option value, the premium, what is the intrinsic and time values of the option if the spot price of Examinator.online is $68 a share? Is that attractive? Yes, because I can sell at 88 when they're valued at 68 in the market. So you can see the intrinsic value there is 20. If the price is $100 in the market, there's no way I'm going to exercise my put option and sell at 88. No, I would sell at the market price. So there, the intrinsic value is 0. So looking at the two situations, the option value $28.50 with the intrinsic value of 20, then the time value must be $8.50. If the price goes up to $100, intrinsic value is 0. So the full option premium must be the time value, $28.50. Now, you're not going to get a question covering all that information, but you could easily get a question just picking off some of the points there. Always remember, value of an option is equal to the intrinsic value plus the time value. Moving on to the factors that affect the time value of an option premium. The time to expiry. Now, we're giving you detailed notes here. With the time to expiry, the longer the time to expiry, the higher the time value of the option. So the higher the option premium. And we do contrast American style and European style options. Market volatility. Now, with both call and puts, if market volatility is high, that increases the probability of the option being in the money because it's moving around, and so the value of an option, whether it's call or put, will be higher the higher the price volatility. So the point that's being made there is, as the price volatility of an underlying security increases, so does the value of both call and put options. Now, with interest rates, if interest rates go up and I'm looking at call options become attractive because instead of buying the underlying asset now, I can delay the purchase by buying a call option, locking into a price now, and the extra funds that I have, because I'm not investing now in the underlying asset, I can put on deposit and I receive a higher interest rate. So call options increase in price when the interest rate rises. It's the other way around with put options. If interest rates went up, then am I going to buy a put option to sell in the future or sell now? It's more attractive to sell now because I'll put the funds on deposit at the higher interest rate. That's the way to think about it. So put options fall in price when interest rates rise. With dividends, when a dividend is paid, stock prices fall because the dividend would have been priced in. When it's paid, stock prices generally fall. So accordingly, as we say here, a dividend payment will lower the value of a stock's call option, increase the value of a stock's put option because of its effect on the market price. Current price versus the exercise price. Closer an option is to being in the money, the higher the time value, even when you're out of the money. So the second point illustrates this. An option that's 100 points out of the money will be worth less than an option that is 10 points out of the money because you're not that far away. Now, those factors can easily be the subject of a question at paper 9.